Okay, dear students, this is Mustafa Mirchawala, your TX trainer, and today we are going to discuss TX pre-mock MCQs for June 25 attempt. Okay, right? So, without wasting any time, and yes, this video will be good for this June 25 attempt. Yes, this will be helpful for you in June 25, September 25, December 25, and March 26. And after that the course will change. Okay, so you can use this video later on for practice as well, for future students I am saying. Now again, for your motivation, few results I want to share with you. See, these are our high scorers of last recent attempt, that is March 25 attempt. You can see I've also shared with this on in my previous class of mock pre-mock, right? So now today we are going to discuss section A. Section A is what you have 15 MCQs, 2 marks each, so it's 30 marks. And yes, there are some MCQs which will be tricky one. Okay, so this class will be full of learning. Try to watch complete class, don't miss this. And if you like it, comment on this on my YouTube channel if you are watching this on my YouTube channel. And also you can share it with your friends also, so it will be beneficial for others. Right now, first of all, question number 1. Brownie Limited owns 95% of Cookie and 100% of Bissy. So this is Brownie, and Brownie owns 95% of Cookie and 100% of Bissy or Bicky, whatever you want to say. Okay, now Cookie owns 75% of Donut, right? And Bicky owns 58% of Wafer, right? Very tasty names. Okay, full of carbohydrates, processed carbohydrates, right? So my dear students, now they are asking which companies are within Brownie Limited's chargeable gains group. Chargeable gains group. Hope you remember there are two types of groups you studied in TX corporation tax area. One is 75% group of companies, remember, and the other is chargeable gains group. Okay, right now we are talking about chargeable gains group. If you want to make a big chargeable gains group, so there are two conditions. At each level the direct holding should be greater than 75%, and if you talk about the indirect holding, it should be greater than 50%. Indirect holding means product of two direct holdings. So it's very simple. Let's start. So first of all, Brownie is directly connected to Bicky. So yes, this is more than 75%. These two are, Bicky is the part of capital gains group of Brownie. Okay, now Brownie also holds 95% shares of Cookie directly, so it is greater than 75%. So yes, Cookie is also part of capital gains group. So Cookie and Bicky, these two are directly related to this capital gains group. Now let's go for indirect holding. Now Bicky holds 58%. So straight away the first criteria, direct holding is Bicky to Wafer. Direct holding is less than 75%. So simply remove this Wafer. Wafer is no more. First condition declined. Okay. Now come to Donut. Cookie owns 75%. So yes, direct holding is 75%. One condition is met for Donut. Now the other condition is check the indirect holding right from the top. So this is 95 and this is 75. So 0.95 multiplied by 0.75. It's, I think, 0.95 into 71. Yes, 71.25%, which is greater than 50. Okay, so indirect holding is greater than 50. So yes, Donut is also part of this group. So we have this group. we have this capital gains group. Just exclude wafer. So yes, cookie, bakery and donut, all these three are part of this capital gains group. So answer is bakery, cookie. Yes, A is your answer. A is your answer. Okay, this was easy scoring areas. You can easily score marks in this. Okay, now the next, Drake started a new sole trader business. He then received new business. See, new business, no more old business. Okay, from HM Revenue and Custom to submit his self assessment tax return for the very first time. He did not submit the return by the due date and still not submitted. That means he hasn't submitted any return. He has not submitted any return. So now indicate by clicking the relevant boxes in the table below which of the following actions HMRC can take in order to collect any tax owing in respect of unfiled return. Listen. Start a compliance check inquiry into the return. No. This is false. Or I would write like this. False. Why? Compliance check. It's a routine inquiry. It is only done once you have submitted the return and they have doubt on your return. But here in this case, we have not submitted any return. So this is false. Then make a determination. Yes. You know what is determination? Whenever you ignore tax department, listen, whenever you ignore tax department, you are not replying to tax department, you are not submitting your return on time, then what tax department do, based on the information they have, they calculate your average tax, and we call it, they determine your tax and they send you, pay this average bill. Okay, but if you submit actual return in front of this average bill or determination, then this determination will be cancelled and now you can pay actual tax. But if you are not paying actual tax, if you are silent, they will send you average bill. They will determine your tax themselves and send you. So yes, if you are not submitting your return, then this will be the action. Now, offer an internal review. No, it's false. Internal review is only done once you have submitted the return, then they inquire about it. Okay. Raise a discovery assessment means if they discover something bad in your return. So for this also you need to submit return. So the three things which are false, for all those three things, first you need to submit the return, but in this question you have not submitted any return. Now number 3, very good question. It's connected to self-assessment individuals. Thomas has been running his sole trader business. He had income tax and class 4 and IC liability for 23-24 of 23,400. First thing, listen. If you want to pay 24-25 POA, payment on account, so the normal rule is, listen, normal rule is 24-25 POA is calculated on the basis of last year. 24-25 POA is calculated on the basis of last year class 4 and IC income tax. Okay, so wait, now this is your 24-25 fiscal year. This is your 24-25 fiscal year. It ends on 5th April 25. So do you know the due dates? Yes, you know the due dates. The due dates for 24-25 fiscal years POA. The first due date is 31st of January 25 and the second one is 6 months after that, that is 31st July 25. Now read the question carefully. Thomas believed that his trade would experience a slump in the tax year 24-25, so made a claim to reduce his second payment on account. He just reduced his second payment on account. That means the first payment on account was based on the previous year. That was normal. The first POA was based on normal, and normal means 23,400 multiplied by 50%. Normal means last year's total class 4 and IC and income tax into 50%. So 23,400 into 50% is 11,700. So here you paid 11,700 POA. Okay. Now what they are saying, So made a claim to reduce his second payment on account to 10,000. He made this reduced payment on 31st. Okay. So this POA, this second POA he paid 10,000. Now use your brain. How much total he paid? The first POA he paid 11,700. The second POA he paid 10,000. So altogether, if you add these two, you have paid 21,700. You have paid 21,700. Okay. Now use your common sense. Thomas income tax and class 4 NIC for the tax year 24-25. The actual tax came out to be only 14,300. So just tell me, did he do any crime? Did he do any misinformation or misrepresentation? No. He already paid more. That means he did not reduce extreme. He was correct. That the actual tax going to be less than last year. Actual tax is going to be lesser than last year. So he was correct. Any balance remaining due was paid on 31st July 26. I would say there will be no balance, even he will take the refund. How much interest will Thomas owe to HMRC in connection with the second payment on account for zero? No interest. Why interest? No interest. You have to pay interest if you pay reduced. If the actual income tax came out to be more than 21,700, if your actual income tax came out to be more than 11,700 plus 10,000 is 21,700, then you did wrong. Then otherwise this time you didn't block any money. Even you were correct in your words. It was right decision. It was correct decision to reduce the POA because the actual tax in reality is lower. The actual taxes are lower. You can see 14,300. And you paid already 21,700, so you paid very good amount. No more, no problem. Okay, no problem. So the interest will be zero. Okay. Now question number 4, again ordinary question, very ordinary question. This is related to CGT companies. If you know the rules for companies, indexation allowance is available till 31st December 2017. Means if you have bought any asset before 31st of December 2017 and you sold that asset after 31st December 2017, so you will be eligible to get indexation allowance till 31st December 17. That's it. After that, no more indexation allowance will be available. Okay. Now please, so there is one purchase, that is yes 2002. 1st June 2002 means before December 2017. We bought 40,000 shares for this price, and yes, we sold it in 2024. Excellent case, but sold only 12,000 shares, so don't worry about it. Excellent case. You bought the shares before December 17 and you sold it after 17, so you will be eligible for indexation allowance till 31st December 17. And yes, they have given you ready-made index factor. So let's do it. Very simple. Number of shares, cost and index cost. So first of all, in 2002 you bought 40,000 shares. The cost is 50,000, 55,000, and you know the day when you buy, cost and index cost is same. Okay. Now next thing is we'll be calculating indexation allowance from 2002 to 2017. Okay. So it will be, the formula is index cost multiplied by index factor, which is 0.578. So 55,000 so let's upgrade it. Your new shares will be 40. The shares will remain same, 40,000 shares. The original cost is 55,000. And yes, your index cost will be 58. No, it will be, wait. 86790. 86790 is your index cost. Okay, now we have calculated indexation allowance. Now later on, we sold how many shares? We sold 12,000 shares, I think. Yes, in 2024. Okay, 12,000 shares will be deducted. Now let's subtract the cost and then subtract the index cost. Very easy, use your calculator. 55,000 divided by 40,000, you will get the per share cost, multiply by 12. 16,500 is the cost. Okay, and now do the index cost, which is important. 86750 is the index cost. 86790 is the index cost, divided by 40,000, because it is the index cost of 40,000 shares, into 12. 26037. Okay, now the remaining, for remaining shares, it's going to be 28,000 shares remaining. 55 minus 16.5, 38,500 is the remaining, and 86790 minus 26037, 60753. Now just read the requirement and you are good. You just read the requirement and you are good to go. Yes, see this. How much? What is the index cost? See the what is the index cost should be deducted in calculating the chargeable gain from the sale of. Yes, how much index cost we should deduct? We should deduct this. For 12,000 shares, this is the index cost. This is your answer. To this index cost should be deducted. This index cost should be deducted, and as you know, index cost means cost plus indexation allowance. Index cost means cost plus indexation allowance. This is the answer. C is your answer. Okay, right? Okay, G. Next question is again in CGT, and this is about chattels, non-wasting chattels. Hope you remember the 4 cases of non-wasting chattels. Okay, I think this is case 3. So Brandy sold an antique, C antique, whereas means non-wasting chattels, tangible, movable property. Okay, in October 2024, for the net proceed is 7,800 after deducting selling costs. So, can you tell me what is the gross proceed? Yes, 7,800 is the net proceed, and what is the selling cost, which is 1,700. So, can you gross it up? Yes, if you add it up, so it will be, I think, 9,500. This is gross. Okay, now she had originally purchased for this. So this is very simple. This is case number 3 of non-wasting chattels. When you buy a chattel for less than 6,000 and you sold it for more than 6,000. So now you have to do two working. The first working is this. See, gross TP minus 6,000 into 5 upon 3. Okay, so gross TP is 9,500 minus 6,000 into this fraction 5 upon 3. Please. Five eight double three. Okay, and the second working is actual working is like this. Your gross TP is 9,500 less all actual costs. So one actual cost is selling cost and the actual other cost is 5,350, which is the original cost of purchase. Okay, so this will be 2,450. So Can you tell me which one is the better to pay? Which one is lower off? So lower off is this. This is the answer. 2450 is your answer. Okay. Out of this and this, you need to pick lower off. Lower off. Okay. Now, next thing. Garrett made a VAT inclusive standard rated supply on 1st December 2024 for 2850. So this is inclusive price. This is inclusive price. Now wait, hold. This is very cash marks. So selling price inclusive of VAT is equal to selling price exclusive plus VAT. Okay. So now wait. Inclusive price is 2850. Now when inclusive price is given, how can you calculate VAT? When inclusive price is given, how can you calculate VAT? Into 20 upon 120. Do it. 2850. 2850 into 20 upon 120 will give you the VAT. $475 is the VAT. So 2850 minus it's 2375. Okay, so it's done. How much is the VAT element? VAT element is 475 and the value of supply, this is the value of supply, 2375 is the answer. Okay. Okay. Now, next is question number 7. Question number 7. Excellent question. Excellent. See, this type of theoretical question normally students feel scary. Which of the following statement about tax return is incorrect? Incorrect. You need to pick in. See, they have highlighted this incorrect. So that means don't pick the correct answer, pick the incorrect answer. The tax return comprises of main return form, yes, together with supplementary pages for particular sources of income, yes. It's like giving you a very basic example. Remember, and non-saving interest dividend. Whenever you are asked to calculate tax of any individual, you need to do non-saving interest dividend. 3 columns. Remember, I teach in such a way. Non-saving interest dividend. These columns come into your mind. Okay. Now, in these 3 columns, you need to put income, and those incomes will be on other pages. Like for employment income, there is a separate P&L. Trading income, there is a separate P&L. Property income, there is a separate P&L. So this is how the return works. One page and then supplementary pages. So this is true. This is true. We need to pick false. Now, a partnership must file a separate return. Yes. And account for each partner's tax. No. No, this is false. Partnership, even if you remember my words, partnership firm never pays his tax. This is the individual partners who pays their taxes separately. So partnership just show one thing in the return, that this is the total profit and this is the share of each partner. That's it. No more tax calculation. That tax calculation will be done separately in those partners' tax return. So this is false statement. Now see, if HM Revenue and Customs calculate the tax for the taxpayer, it merely does so based on the information provided and does not judge the. Yes, true. This is true. Let me recall you. Let me recall you with date. For 24-25 fiscal year, for 24-25 fiscal year, if you submit your documents to tax department before 31st October 2025, so they will calculate the tax departments. There are teams in the tax department. They will calculate tax for you. They will calculate tax for you. Okay. Right. And they will calculate tax for you based on the information you provided. Okay. So if you provided wrong information, so you cannot blame tax department later on that you calculated wrong tax, because the information given by you is wrong. Okay. Right. So don't think it will be error free. If you have provided wrong information, so wrong tax will be calculated. Read it carefully. Now, an employee who only has employment income with the tax collected under payee is not required to complete it. True. Because only employment income, we have done in the class the questions employment income with interest income and other incomes as well. So only employment income, and that on that employment income you have paid pay every month. So that means you have paid actual tax on that employment income. You have paid actual tax on that employment income, so you don't need to pay anything extra. So this is true. So the false is B. False is B. Okay, incorrect statement is B. Now, but be practical, be practical. Try to live in the real world. In such questions, there are good students who do mistakes. This is normal. It happens. So get ready. And I don't want 100 marks from you. You can get 98, 88, 78, 68, 76. This is the routine thing, okay? So be practical. For the year ended 31st March 2025, early time limited has taxable profit TTP of 220. This is corporation tax basic question. The company also received dividend from non-associated companies during the year. Okay, so can you calculate it? The AP? Yes. First, AP augmented profit. Your TTP is 220. Then dividends from non-associated companies 13. So your augmented profit AP is 233. Okay. Now hope you remember the corporation tax. Listen, corporation, let me do here. How to do corporation tax calculation in such cases. First of all, first thing, listen. First thing is, you tell me the low, this this augmented profit is more than 50,000. Augmented profit is more than 50,000, less than 250,000, more than 50 and less than 250, more than 50,000 and less than 250,000, right? You getting? So first of all, on this TTP 220,000, 25% rate, 25, you must know it. This is the revision class. You have taken normal classes. 220,000 into 25% rate. 55,000. Now you can deduct less marginal relief. Hope you remember it. Hope you remember the formula. Less marginal relief. Why marginal relief is given? Because it is your AP is more than 50,000 and less than 250,000. More than 50, less than 250. Remember? So now what is the formula for marginal relief? Upper limit, which is 250,000, less AP, which is 233,000, into the fraction is 3 upon 200, multiply by TTP upon AP. TTP upon AP. TTP is 220 upon AP is 233. Okay, right? Hope you remember it. This is very basic thing. This is very. I have not written three zeros with 220 and 233. Okay, I know this much maths. So your marginal relief will be 241. 54759. 54759. Okay. Okay, dear student, before we move on to the next MCQ, let me show you one thing of my class. Listen, there is a topic UK resident and non-UK resident. Whenever you are into this topic, whenever examiner asks you for this topic, simple, very simple rules. Even I teach in class on such a way. Bring that guy in front of you. Bring that guy in front of you now. Always first of all apply compulsory test. There are two compulsory tests. The first one, always the first, this is the order. See, always go for this. Always go for this. First of all, compulsory non-resident test you need to apply, and then compulsory residency test. Okay, what is compulsory non-residency test? See the screen. A person who is in the UK for less than 16 days, if he is in the UK for less than 16 days, whoever he is, he is non-resident. That's it. No more discussion. That's it. Second point, a person who is in the UK for less than 46 days plus who has not been resident during 3 previous tax years, still he is non-resident. No more, no question asked. A person who works full-time overseas, subject less than 90 days. Okay, right? If a person, a boy or a girl meets one of this condition, he is non-resident. Thus chapter close. Second thing, if out of these 3 points no points apply on this guy, then come to compulsory residency test. 1, 2 and 3. If he meets any one of the information, any one of the thing out of these 3 points, then he's full-time resident, compulsory resident. Okay, so always go for compulsory test first, compulsory non-resident test first, and then compulsory residency test. Okay, right? This is the order of decision making. You won't be, this is second number. You won't be wrong. Okay, let's start the MCQ. I have just showed you the real law. H and G arrived in the UK during the tax year 24-25. Neither had previously. He is like me, freshly going to UK. For example, I am going to UK freshly. I live in Pakistan or I live in US or anywhere. Now I am going to first time to the UK. Okay. Neither had previously been resident in the UK. Neither of them worked in the UK during the tax year 24-25. Okay. So no more. In past we are no more UK resident. In July 24, each acquired a separate homes in the UK. Neither of them has any other home. This is very important condition. Very important. But wait. In the tax year 24-25, G spent only 39 days. Means G spent less than 60 days. 46 days. G spent less than 46 days plus in last 3 fiscal years he or she is no more UK resident. So that means we'll apply a stamp on Mr. G or Mrs. G, whoever he or she is, that this person is compulsory non-resident. Why? Because the stay is less than 46 days, more than 16 and less than 46 days, plus in the last 3 fiscal year non-resident. So compulsory non-resident. This Mr. Gretel or Mrs. Gretel or whatever is compulsory non-resident. Okay. Now come to the Mr. H. First apply. There is one order. Apply non-residency test. Did he stay less than 16 days? No. Did he stay less than 46 days? No. Right? Okay. So that means compulsory non-resident test does not apply on him. Compulsory non-resident test does not apply on him. Okay. Now come to compulsory residence test. Now the next test. In compulsory resident test, if you have only home in the UK, no other places, then you are compulsory UK resident. And yes, they each acquired separate homes in the UK. Neither of them has any other. So yes, this Mr. Hansel fixed in the compulsory automatic test of residency, so he or she is resident, okay, in the UK. So which of the following is a resident in the UK for the tax year 24-25? Only this, not G, okay, because Mr. Hansel meet the compulsory residency test, automatic test, okay, but Mr. G met the compulsory non-resident test, and always we'll see what is the order. Always see compulsory non-resident test, then compulsory resident test. If a person does not fix on compulsory non-resident test, then you can go to compulsory resident test. Be careful with this thing. Still, if you want to read, let me see this. You can read it again. You can read it again, please. First 3 points and next 3 points. First 3 and next 3. This is your exam preparation, please. Very interesting question and very useful question. Very useful question. It's full of learning. Each and every TX student must know this thing. Many I have seen in last 20 years, many students are weak in this area. So listen, if you know there is a topic long period of account, even I taught this in class, long period of account in corporation tax. So they have a 15-month period, 31st March to 2025. So their period of account is starting on 1st of January 24 to 31st of March 25. Okay, now first of all, for the purpose of tax calculation, we can maximum tax we can pay for 12 months. For the purpose of tax payment, maximum tax we can pay for 12 months, the accounting period. So if you get such question of 15 months, you need to break first 12 months. See, this is first 12 and then remaining 3. Okay, so 31st December 24. So what we do, we break such question into first 12 months and then the remaining months. Okay, now we'll calculate, listen to me, we'll calculate separate tax for first 12 months and last 3 months, and we'll pay them separately as well. Payment is also separate, calculation is also separate, payment date is also separate. Payment date, you know, if it is a small company, then from the end of the accounting period, this is the first end and this is the send. From the end of the accounting period, the due date is 9 months plus 1 day. 9 months from plus 1 day from the end of the accounting period. Okay. So for the purpose of corporation tax calculation, we'll divide first 12 and remaining 3. For the purpose of payment, separate. But the last thing is tax return. When to file the tax return? Listen. Yes, when these two are separate accounting period, they have separate taxes. So we need to file 2 returns. Yes, we need to file 2 returns, but the due date for those returns are not from this date, not from this date, but from this date and 12 months. You know, for due date is always 12 months. For tax return of companies, it's 12 months. So 12 months from the end of the period of account, and that is 31st of March 26. And yes, both tax returns will be filed on this date. This is the last due date for both return filing. Both return, I'm talking about return. Okay, this is the technical area, not about tax payment, it's about tax filing. Yes, we'll submit 2 returns, but on this date. So 12 months from the end of the period of account. This is the end of the period of account. So let's see. DFB Limited has decided to change its accounting dates ahead of 15 months. See, 15 months, we got that topic. By which date DFB Limited file its corporation tax self-assessment tax return for 15 months period ended 31st March 25. The return for the year ended 31st must be wrong. 1 return, no, 2 returns. The return for the year ended must be no. The returns, yes, returns means more than one, more than one. For the year ended 31st December 24 and 31st must be filed by this date. Yes, this is true. D is true. Important question. This is important area. I have seen many times they test this thing. The next thing is this is IHT now. IHT. You know about the lifetime gifts. There is one gift which is called PAT and the other gift is CLT. Chargeable lifetime transfer. This is gift to trust. Gift to trust. Listen. Linus died on 5th of November 20. This is the date. 5th November 2024. Okay, this is the date of death. Having made a lifetime cash gift to a trust CLT. Okay, on 16th of October 2023. That means yes, few 1 year before CLT on October 23. Sorry, October 2023. Okay, now and yes, she died just in 1 year or 1.5 years. So yes, this CLT will be chargeable. This CLT will be chargeable here. Okay, CLT will be chargeable here at the time of death. Okay, so you know now in CLT you have to pay two taxes. The first is lifetime IHT, which is paid during your life. Okay, and the other is additional IHT on CLT. Additional IHT on CLT, and when it is paid, you know, if the donor died within 7 years, if the donor died within 7 years of the date of the gift, and yes, this is the case, donor died within 7 years of the, just in 1 year, donor died just in 1 year. So in this question, additional IHT is to be payable. Okay, now very simple question. Select who will be responsible to paying additional. See the line, additional IHT. It's always trustees. Trustees pays additional IHT. Donor is died. Donor is no more in the world. Donor is no more in the world. So Linus has already died now. Okay. So additional IHT is the responsibility of trustees. Okay. Then, and what is the due date for additional IHT? It's very simple. All death taxes, there is one date. Just see the month of death. Month of death is November. Month of death is November. Just come to the end of the November, which is 30th November. And now exactly 6 months. Exactly 6 months from this. So 30th November 2024, if you add 6 months, it will be 31st May 2025. 2025. Okay. So this is the due date. Sorry. This is the due date. Okay. So month of death, and come to the end of the month of death, and then 6 months. Simple. Okay. Next. Mouse House Limited is a UK company that incorporated on 1st December 24. This is date of incorporation. The company started to trade on, this is the date of the starting of trade, and made up first accounts to 31st August 2025. Now, by which date must Mouse House Limited notify? Notification of, there is a topic in the book, in my book as well, notification of chargeability. Hope you remember. Notification of chargeability, that yes, you have started a new trade. So that is very simple, very simple. Within 3 months of the start of the trade, notification of chargeability, there is only one line, within 3 months of the start of the trade. So this is 1st February. See, the start of the trade is 1st February to 2025. Add exactly 3 months. So 1st Feb to 1st March, then 1st April and 1st May. Yes, this is the due date. This is the due date. Okay, next. Once again, A little non-routine part, a little non-routine part. Yes, we have discussed this in the class, but normally very less practical question for this. Listen, Blair has Blair has lived in a job-related accommodation provided by her employer for many years. She was provided with a accommodation for her personal security due to nature of the job. Yes, remember the job related accommodation. If there is some threat to the life of the employee and employee is using accommodation just for the security purpose, then yes, it is a job related accommodation. And hope you remember, in job related accommodation there is no annual value benefit. There is no annual value benefit. It's exempt. There is no additional benefit, exempt. But yes, listen my words, the ancillary benefit, which is like heating cost, electricity bill, it will be restricted. It will be restricted to, remember my words in my lecture I use, to 10% of net earnings. Net earnings means net employment income remuneration, net salary, 10% of net salary. Okay, it will be, this is also a relief, I'll explain you. So there is no annual value benefit, there is no additional benefit for job related, but yes, your ancillary benefits are restricted to 10% of net earnings. Now Blair has annual gross salary of 50,000. Important information. For the tax year 24-25, her employer always pays heating, cleaning and lighting. Yes, these are ancillary benefits. And the actual cost is 7,000. Actual cost for this is 7,000 pounds. Keep this actual in mind. Her employer also provided with furniture. So furniture is a non-cash benefit. Furniture is a non-cash benefit. So for furniture you will calculate, just telling you extra things, furniture you will calculate usage benefit of 20%, right? Now but see the requirement, it's a different requirement. What is the total amount accessible into income tax of Blair in the tax year 20 in relation to the furniture, heating, cleaning and lighting cost? Furniture, heating, cleaning and lighting cost. Okay, right? So now listen, what you need to do, you just write lower off. You just need to write lower off what I have written. Please check it out. Please check it out. Okay, now just one change I want to do, so that otherwise when you will be doing it yourself, it won't match with your solution, right? Her employer also provided Blair, make it, this is your annual value. They are treating it as annual value. Okay, remember in the accommodation there is one thing which is called annual value. So the annual value of this is 10,000 of this house. Just cut this furniture and make it annual value. Okay, now what is the total amount accessible to income tax in relation to the heating, cleaning and lighting cost? Okay, so in this case you need to do, it should be restricted to, remember ancillary benefits are restricted to 10% of net earnings. So 10% of your net salary. Now your salary is 50,000, multiply by 10% is 5,000. Okay, this is one limit. And on the other side write your actual cost. Your actual cost is 7,000. Your actual cost is 7,000 pounds. Your actual cost is 7,000 pounds. Now just take the lower off. So lower off is only 5,000. So answer is 5,000. Now hold, relax. You know, job related accommodation, government wants to give you relief. Government wants to exempt your tax. Government wants to give you relief. Okay, so that's why there is no tax on annual value. There is no additional benefit tax, and ancillary benefit is also restricted to 10% of net earnings. What do you mean by? See, the actual bills which you enjoyed is 7,000, but still you just need to pay tax on 5,000. So this is the benefit. Okay, right? And now let me give you the reason why I changed this furniture to annual value, because when you do it yourself, when you do it yourself and you will go to the solution, in the solution commentary you will be confused. So I have cleared that confusion. Okay, so they are treating this as annual value, and annual value is exempt. Annual value is exempt. Okay, right? Okay, this is important question. This is important question. Okay. And I repeat, for any furniture, you know, for on any furniture, if an employer gives you, listen, even I covered this in my last pre-mock class as well. That was employment income related. For any furniture means assets other than car for private use. For any furniture, the usage benefit is 20%. So if you treat this as furniture, then what will be the usage benefit for this? It's 10,000 multiplied by 20%, 2,000. 10,000 multiplied by 20%, which is 2,000. Okay. But I have removed furniture overall, right from the requirement as well and from the question as well. Okay. To remove the confusion. Now, only two questions are left. Be active. This is also good. This is also good. Pre-registration input VAT. Hope you remember this topic. Pre-registration input VAT. There is a topic, pre-registration input VAT. So Farina commenced her sole trader business on 1st June. Be careful. 1st June 24 and registered for value-added tax on 1st October 24. Excellent. The first VAT return for her business is for the quarter ended 31st December 24. That means actual months are October, November, December. Actual months for which we are filing our VAT return is October, November and December. Be careful. During the period from 1st June 24 to 31st December 24, the business incurred ready-made input VAT they are giving you 110 per month, 110 per month in respect of hire of office equipment. So that means this is a service. We have taken office equipment on rent or on lease. So that means we are taking services. This is service. How much input VAT in respect of the office equipment can Farina reclaim on our business VAT return for the quarter ended 31st December 24? Excellent question. Listen. We all know she registered on October. So these 3 months are real. October, November, December are three real months now. And this is the date of registration. Hope you remember a topic. There is a topic called pre-registration input VAT. What does it mean? That if you have incurred any input VAT, if you have paid any input VAT, any VAT on services. First, let me tell you about services. In last 6 months from the date of registration, in last 6 months. So what are the last 6 months? It's going to be September, August, July, June, May and April. If you have paid any input VAT in last 6 months from the date of registration, then yes, now you can claim. So yes, the business started when? The business started in 1st June. June, July, August, September. And these three are the real months. So according to the last 6 months rule from the date of registration, these months also lies in last 6 months. These June, July, August, September also lies in last 6 months. So these 4 months we'll claim through pre-registration rule, and these 3 months are actual. So total 7 months input VAT we'll claim. Total 7 months input VAT we'll claim. Okay. And for the 1 month it's 110. So 110 multiplied by 7 months is going to be 770. This is the answer. D is the answer. Think over it. Let me say this in Urdu language. There are some students, they love Urdu, Hindi language. देखें, अक्टूबर, नवंबर, दिसंबर, ये 3 महीने तो हमारे असली हैं. इनका तो रिटर्न फाइल हो रहा है और इनमें तो हमने इनपुट वैट पे किया है. और 1 अक्टूबर को हम रजिस्टर्ड हुए हैं, तो वहां से लेके पिछले 6 महीने का रूल जो होता है प्री रजिस्ट्रेशन इनपुट वैट फॉर सर्विसेज, तो वो भी तो हम क्लेम करेंगे ना. तो पिछले 6 महीने में से 4 महीने जो जून, जुलाई, अगस्त, सितंबर है, वो वही तो लाए कर रहे हैं. उन्हीं 6 महीने के अंदर लाए कर रहे हैं. एंड जस्ट फॉर योर हेल्प, there is a pre-registration input VAT for fixed asset and inventory as well. That is a separate topic. Hope you have done this. Pre-registration input VAT for inventory and fixed asset. Okay, now once again, where all MCQs are good. Now, this is the, hope you remember for companies. For companies, if you are a large company, then you have to pay tax and installment. If you are a small company, you have to pay tax in 4 installment if the accounting period is 12 months. Companies. And if you are a small company, then you need to pay tax from the end of the accounting period, 9 months plus 1 day, 9 months plus 1 day, 9 months plus 1 day. Remember the rule, okay? But there is one topic I have taught in class. I remember that even you are a large company right now, but still you can avoid installments. Yes, you can avoid. How? Wait. See, the rule is, although you are a large company now, but you are not large in the last year. You are not large in last year, plus your augmented profit is less than 10 million pounds in the current year. Repeat. Right now you are large, yes, but you are not large in the last accounting period. Plus your current year augmented profit is less than 10 million. It's not 1 million, it's 10 million pounds. Then you can still avoid installment and just follow the rule 9 months plus 1 day, 9 months plus 1 day, 9 months plus 1 day. Getting? So let's do it. Bass Boomers Limited commenced trading on 1st January 23. This is the first year. It has always has one associated company. So limits will be divided by 2. So 15 lakh is the upper limit for small or large, divided by 2. So your limit for this question is 750,000. This is the limit. Listen, this is the limit for identification of small or large. And this small or large has nothing to do with tax calculation. Listen, this small or large has nothing to do with tax calculation. It has to do with tax payment, timing of tax payment. Remember? So let's do it. So you have first year December 2023, then December 2024, December 2025. Now wait. In this year, your AP is 452. 452 means less than 750. That means you are a small company. You are not a large. In the first year, you are not large, so you don't have to think about installment. In the second year, listen, see the question. Your augmented profit is 993. Yes. In 993 means greater than 750. See the revised limit. 933,000 means greater than 750. That means right now you are large. In December 2024 you are large, but still you are eligible for exemption because last year you were not large. So in December 2024 again you don't need to pay corporation tax and installment. Still you can avoid installments. But in December 2025 now you are large because 1 million, which is greater. Now you are large, plus last year you are also large. Now you are large, plus last year you are also large. So this time you have to pay in installments. From December 2025 years you have to pay in installment. No more exemption for you. Okay. So what is the first year for which Bass Boomers will be required to pay its corporation tax liability by quarterly installment? This is C answer. This is your answer. I hope you enjoyed the class. This is good class, full of concepts. Okay, so if you like it, give your feedback, share it with your friends, and be confident. Small things. There are things, little things in your F6 TX paper. Okay, so best of luck for your upcoming exams. Thank you and take care. Bye.